South Korea is about to treat major crypto exchanges like banks. Tougher rules and bigger penalties are coming to one of the busiest digital asset markets on the planet. Regulators in Seoul are preparing a new framework that would put large crypto trading platforms under the same style of oversight as traditional financial institutions. Until now, that model applied mainly to banks and electronic payment services under the law on electronic financial transactions. The plan is simple in theory, but strict in practice. If you run a big exchange in South Korea, expect to live under bank-grade standards for consumer protection, internal controls, and compliance culture. The goal is to stop platforms from cutting corners while the local crypto market grows at high speed. The Financial Services Commission is drafting amendments that tighten information technology security rules and raise the bar for both systems and staff at registered exchanges. Platforms will need stronger risk management, better incident reporting, and clearer lines of responsibility when something goes wrong. One of the most striking proposals targets hacks and security failures. Regulators are considering a rule that would allow fines of up to 3% of annual revenue for serious breaches. That is the same ceiling already used for banks. Today, crypto venues face a much lower maximum penalty, capped at the equivalent of $3.4 million. For major Korean exchanges like Upbit, Bithumb, Coinone, Korbit, and Gopax, that change would be dramatic. A percentage-based fine can scale with growth and hurt far more than a fixed cap. It sends a message that losing customer funds through poor security is no longer just a cost of doing business. It can threaten profits and careers in the executive suite. Officials say the new rules should also reduce the impact of outages and service disruptions at the largest platforms. If exchanges know that weak systems can trigger serious financial and reputational damage, they have a powerful incentive to invest more in resilience and client protection up front. Meanwhile, the Financial Intelligence Unit has already warned domestic crypto operators that penalties for ignoring anti-money laundering rules and other digital asset laws are getting tougher. In other words, compliance risk is rising on multiple fronts. For traders and investors, stricter oversight is a double-edged sword. On one side, tougher security and clearer accountability can make exchanges safer places to hold and trade assets. On the other side, higher costs and heavier rules could push out smaller players and reduce choice, even as they legitimize the biggest firms. These moves in South Korea also fit a wider global pattern. From Europe to North America and Asia, regulators are gradually pulling major crypto intermediaries into the same orbit as banks and brokers. The message is that if a platform handles customer money at scale, it will be treated as a core piece of financial infrastructure, not as a casual technology startup. In practice, that means more audits, more documentation, and more personal responsibility for executives. It may slow down flashy product launches, but it can also reduce the risk of spectacular failures and chaotic liquidations that damage trust in the entire asset class. Investors watching the Korean market will want to track how quickly these reforms move from proposal to law and how firmly they are enforced. A strict rollout could set a template for other countries with active trading communities, while a softer approach might encourage regulatory arbitrage and offshore migration. For now, the signal is clear. If you operate a large exchange in South Korea, the era of light-touch supervision is ending. If you trade on those platforms, expect more security reviews, more compliance prompts, and possibly higher fees, but also a more robust environment. This has been BlockBrief. Stay informed, stay ahead.